Then we look at how to determine forward rate using how to determine forward rate using the issue price. Yeah. I'm trying to be fine. Thank you, Ken. Thank you. So we look at how forward rates, how we can use the issue price to determine the forward rate. And if you look at the trend of question from in bond valuation, you could see that last diet, the question on bond valuation last diet was on forward rates, how to use it was on issue price, how to use forward rates to determine issue price. Now, nobody knows that maybe this time it will be how to use issue price to determine the forward rates. So please go back to the video so that you can be able to at least solve question, even if you can actually see it, even if you see it, fine. All right, so please just go back to the previous video on that. In today's class, we shall look at another topic entirely. I think this covers about 25% of our syllabus. And I can do something last diet. They brought decision tree. Of course, decision tree is very simple. We'll look at simulation as well. For the worst case scenario, simulation, decision tree. By the time we solve one question on decision tree, you should be able to solve last diet's question on decision tree. Now, what leads us to capital budgeting or investment appraiser is still the function of a financial manager. As a financial manager, you need to identify a capital investment project that is viable. When you identify a project that is viable, which is the investment decision, then you need to look at how do we source for this finance? The sources of finance take us to the cost of capital. Now we are back in investment appraiser, meaning that you've identified a project, then we need to calculate the sources of finance, looking at the cost of equity and the cost of debt. Now, where is the project? So we need to come back and calculate if the project will be viable or not, right? If the project will be viable or not. Now, what is, either you call it capital budgeting or you call it investment appraiser, well, it is still budgeting. It is still capital in nature, right? Now, as a financial planner or as a financial analyst or as a portfolio, as the case may be, right? A capital budget decision is as the firm's decision to invest its current fund most efficiently in the long-term assets. Now, with the anticipation of an expected flow of benefits over a series of years. When you look at a capital investment project, when I used to work in real estate firm, we look at, let's say, in construction industry, construction for instance. So we're able to project that, okay, at the end of this construction, they will have three units of 3-bedroom. So at least if you want to rent it out, the rental value based on comparables, maybe because we do research, you look at the market situation and you say, okay, maybe the going rate will be maybe 1.5, right? You know, you've not executed the project, but you are expecting that, okay, this could be cash inflow, right? This could be what? The cash inflow. So it's to ensure that the resources of an entity are effectively what? Utilized. Now, in making an investment decision of a firm could be that they want to go into expansion. It could be because they want to go into acquisition. It could be all of this. Generally, it is known as what? Capital capital budgeting decision. Now, having explained this, we quickly move to the part again where I equally explain these terms again. That okay, capital budget is a program of capital in nature for the next few years, updated every year, setting out details of the capital project, authorized but not yet undertaken. Of course, when you're projecting for what you want to have, cash flow, future cash flow, you've not undertaken it, but you're doing what? You're actually what? Projecting what the cash flow will be at the end of the period. So you can read through all this process of capital budgeting. Now, another thing you need to know here is the classification of investment decision. Class, as a project finance manager or as a project finance officer, you have a project that are capital in nature. You have different type of decision. There's different. We have different classification of capital investment decision. Namely, you can make a capital decision based on expansion of existing business, based on expansion of a new business. Maybe you have to expand, right? And it has to do with what? Capital in nature. Now, replacement cost. Replacement cost is actually covered in financial management, FM, right? So replacement cost, you want to know what time will you be replacing your assets? Is it every 3 years? Is it every 6 years? Is it every 4 years? Capital investment for market position, for new products, and all that. Now, another capital investment decision you may make is what we call mutually exclusive. Now, please take note of all these terms. Mutually, especially mutually exclusive, dependent project, dependent project, independent, divisible project, and indivisible project. These are the terms we will use when we get to capital rationing, right? When we get to what capital rationing. Now, mutually exclusive investment. When you are making a capital investment decision, you may also make a mutually exclusive project decision. What is mutually exclusive means that which serve the same purpose. It's a project that serve the same purpose, right? If you pick A, you can decide to reject B because it is still the same. They serve the same what? The same purpose. Another thing here is independent investment. These are, you can make a capital investment decision based on independent projects that do not compete with each other. It is independent, it stands on its own. You cannot undertake that project in part. It is stand alone, right? It has no impact on other what projects. That is independent. Then we have what we call independent projects. It is still part of what capital investment decision, whereby you have a dependent project, whereby they will tell you that this project is very important. We must undertake this if you want to undertake this. So it depends on A may depends on B, or B may depends on what? A. And there's what we call divisible investment projects. What are divisible? Divisible projects are projects that can be undertaken in part. A practical illustration, you are constructing, maybe there's a construction, let me use FCT for instance. or let me use Lagos for instance, maybe Oshodi, thereabout, right? And they they have to complete one part, right? So you can undertake a project partly, right? And say, oh, because of why will you have to do that? Because you don't have enough fund, right? You don't have enough fund to finance the project. So when a project is divisible, divisible means you can take it in parts. You can take, let's say, if the project will cost you 100,000 and you have 50,000, you can just take 50% of the project. The remaining 50, maybe you take it next year. That is divisible. You can undertake it in parts. Then anything that has to do with indivisible means that you cannot undertake this project as part. It is as important as anything. You must, because the road is express. Like, they need that road. You can't undertake it in part because of the nature, right? Now, these are all capital investment decision, right? So on that note, we need to move quickly to investment appraisal techniques, right? Now, guess what? I can we not come and say, oh, using the model or using the traditional when we are not in skills level, right? And even the payback period, we'll just talk about it, right? We'll just talk about it, but don't expect all those kind of questions at a professional level. Payback and counting rate, or what is it called? Accounting rate of return. But we'll just mention it so that we can move on, right? Now, under the investment appraisal, there are two techniques, right? We have what we call the traditional approach as well as the modern technique. Now, when you're using a traditional approach, it does not consider the time value of money. That is why we have the payback period as well as what the accounting rate of what return. The payback period makes use of cash flow, but does not consider the time value of money. The accounting rate of return makes use of accounting profit. Accounting profit is subjective. Is that not so? It's subjective. Now, modern. Now, the time value of money, it consider the time value of money where we have the net present value and what the internal rate of what the internal rate of return. Now, let's pick it one after the other under the traditional approach. Now, there is payback period. Payback period means the time it will take you to recoup back your investment. If the project is for 5 years, when you calculate the payback period, you have 3 years. It means that it will take you 3 years to recoup back your investment. That makes sense. Right? As a project finance manager or as a project finance officer, right? As a project finance officer, you have decision to make. You just need to, like, okay, if this project is for 5 years, okay, what are the expected cash flow? These are the expected cash flow, right? Okay, let's say for instance, it will cost the company 60,000 naira, right? If it costs them, what are the expected cash flow? Let's say year one, they will they will receive 50,000 or they will receive 5,000. You know, they've invested 60,000 naira as cost. Now, year one, they will collect 5,000 naira. It remaining 55. Year two, 5,000. It remaining 50. Year four, and so on and so forth. You see, immediately after you recoup back your investment, any other cash flow is useless under payback period, right? Under the what? It doesn't consider any other cash flow after you have recouped back your what investment. That is one of the disadvantage, right? So what is the decision? The shorter the period. Of course, if the project is to last for 5 years and you calculate the payback period to be to be what is it called? To be 3 years, and the project will last for 5 years. Of course, it takes a shorter period, right? Right? It takes a what? There's what we call discounted payback period as well, right? I think we may look at discounted payback period, right? We may look at that, right? So we may look at. Thank you. So we may look at projected, right? No, discounted payback period. I think I have to check for question on that. I will pick that question from FM. So discounted what? Discounted payback period, right? We'll look at that, right? So under the accounting rate of return, under the accounting rate of return, but don't even expect all those questions from all those places. But then we'll look at it. We'll look at it. Accounting rate of return, right? So it makes use of accounting profit. And if you want to determine your accounting rate of return, it is average profit after tax divided by the what? The average investment. The question now is, what is the average profit after tax? So average profit is you had all the total profit together, right? When you had all the total profit together, you divide it by the numbers. We give you the what? The average what? Profit. What is the average investment? Average investment is calculated as the initial investment plus scrap value plus scrap value plus working capital, if any, right? Then divided by the what? Divided by 2. Now, when you calculate the accounting rate of return, right? Don't forget that it makes your accounting profit and it's subjective disadvantage. Now, when you calculate it, if it is greater than the cost of capital, the cost of borrowing fund, if it is greater than the cost of borrowing fund, it means the investment is viable, is worthwhile. It means the investment we do what? We maximize shareholders what? It makes sense if the accounting rate of return is higher than the cost of capital, right? It makes sense. Now, having explained accounting rate of return, now we need to quickly, after explaining the accounting rate of return, we talk about the payback period, we talk about the average, we talk about the accounting rate of return. Now we want to focus on cash flow. Of course, we are all professionals, right? Of course, cash is king, right? Cash flow is actually different from what? From accounting what? From accounting what? From accounting profit, right? Now, sometimes I think one of the LinkedIn influential, one of the guy, he said that most Nigerians, right? Let me don't say it, but that's fine. But he said most people we look at money in the real term, right? We look at money, we'll get there actually. We look at money in real term. If I pay you 20,000 naira salary, whether net or gross, today we look at it that it makes sense. 20,000, it makes sense. But considering in real term, considering the inflation of 21.2%, but we'll get to that point, sure. But what I'm trying to explain here is that when you're talking about cash flow, it is maybe either the future cash flow or we still have historical cost, we have the sunk cost. Now, let's quickly move to the net present value part under the what? Under the modern techniques, under the modern approach. Now, before we move to that NPV, we need to talk about the relevant cash flow. Class, if you have to go back, we have to just quickly go back to relevant costing because we'll look at a question tonight on that, right? Now we need to go back to relevant costing. Class, under the NPV approach, if you want to determine your net present value, your cash inflow minus your cash outflow, you consider tax, you have net cash flow after tax, you discount it, you have your present value, you subtract your present value from your cost, you have your NPV. Class, when you are calculating the NPV, you consider the relevant cash flow, the relevant costs that are relevant to the what? To the project. Of course, we know that sunk costs or committed costs. or historical costs are not what? Are not relevant. Of course, we know that depreciation, provision, apportionment, right? And a fixed cost, not incremental, fixed cost is not what? Is not relevant, right? So when we see all this kind of thing in a question, we know that, okay, this is sunk cost, committed cost, sunk. We have committed it that we will pay salary. The salary is what? Is a committed what? Committed cost. Now, opportunity cost. Alternative forgone is always what? Is always relevant. It could be that if they want to continue this project, they have to pay a redundancy fee of 50,000, right? If they don't want to continue with this project, they will not pay a redundancy fee of 50,000 or of 100,000. Now, the decision will now be, will I continue? The decision will now be, oh, if we continue this project, we have to pay a redundancy fee of 50,000 naira, which means we want to go into this project. True. Okay. If they go into that project, right? If they go into that project, what they forgone, they have to bring it in, because that thing's supposed to give them like 500,000. Because of this project, they decide that, okay, let's go for the project. We'll get there. Opportunity cost is always what? Relevant. Now, the question that we state whether the opportunity cost will be your inflow, your cash inflow or cash outflow. It depends, right? Now, financing cash flows, the preference shares, of course, we know this. Preference shares, dividend, and all that, they are not relevant. Do you know why? Because we have make use of them when we want to determine the cost of capital, right? We'll make use of it when we want to determine the cost of capital. So therefore, cost of capital that we use to discount the project, we'll make use of it already. So it is not relevant, right? Now, working capital is what you use to run the business. Of course, without the working capital, the project may not even be viable, because you need what you will use to start it, right? Probably for the purpose of this class, I may use maybe 50,000 naira to commence the whole, maybe next gen, for instance. And at the end of the diet, I will say, okay, I need to recoup back my money, which is 50,000. So that is how working capital works. At the beginning of the project, at year 0, so it becomes an outflow. At the end of the project, you receive it back. It becomes what? Inflow. It is in and out, right? That is what? Working capital. We'll get there in the question, right? So now another thing is, okay, that is terminal value. Okay, now let's quickly move material, right? Material. When material needed for a project is available in the company. Class, please, let's pay attention to this part, please. When materials needed for a project is available, right? When material is needed for a project is what is available in the company. If this material is available in the company and as alternative uses, the relevant cost is the replacement cost, right? The replacement cost may not be as exact material that is available and that is still have the alternative use. So if it has alternative use and the material is available, the relevant cost will be the replacement cost. Now, when material is available but has no alternative use, alternative use, of course you have to sell it. So the relevant cost is the net realizable. Net realizable means maybe you sell it 50,000. In the process, you have to incur 10,000. So 50,000 minus 10, that is the net or the sellable value. But when material is not available at all, you have to go to the market and get the material. And what is the relevant cost? the relevant cost is the current purchase cost that you can get that same product in the what? In the market. And that is material what? Material analysis. So we must understand that when it is available as alternative uses, the relevant cost is the replacement cost. Now, when it has no available, not has no alternative use, right? Of course, we have to dispose it of. So the relevant cost is the sellable value. Then when it is not even available at all, you have to go to the market and buy the same material, which is what? The current purchase cost. Now, having explained this, we have the labor. We have what? Labor. When full-time, of course, the salary they pay is a committed cost. Is not what? Is not relevant for decision making. But if it is for the purpose of the casual labor that they will use them in that project, right? The cost is relevant because it is for that project. However, and over time, right, is also what? Is also a relevant cost, right? Now, variable overhead is always relevant unless stated otherwise. Is always what? Relevant. Now, fixed overhead is not relevant unless the examiner gives the portion that is incremental. Meaning that if the fixed overhead, right, given to us is incremental, it is relevant. Attributable, specific, or relevant. Now, anything that has to do with apportionment, allocation, fixed overhead without incremental, it is not a relevant cost. It is not. It is only an incremental overhead that is what? That is relevant. Now, the MPV, right? Consider this time value of money. MPV considers what? The time what? The time value of money. Right? So, in determination of your MPV, you have your relevant cash flow, inflow minus outflow. You have your net cash flow. You have your tax. Then you discount, whether using real cost of capital or using money cost of capital. We'll get there, right? The present value, then you have your MPV, right? What is the interpretation? The popular interpretation is that when MPV is positive, okay, the project is viable. Fine, the project is viable. What is the implication of this project? You've analyzed it. You've analyzed it, right? And you said it is viable, right? What like, can you interpret it? It is viable. We know it is normal language. It means that the project will maximize the shareholders' wealth. When you see an MPV that is positive, it means that it will maximize share, meaning that shareholders will get return on their investment. When it is positive MPV, when it is negative MPV, it means that the project is not viable and it will not bring a return to the investors, right? To the shareholders. Now, there's what we call internal rate of return as well. Internal rate of return is under the modern techniques. After the MPV, we have your internal rate of return, right? So it is calculated the way we normally know, the lower rates plus positive MPV. Of course, it is what. So what is the decision under the internal rate of return, right? The decision is that if you calculate the internal rate of return and you have 2%, now you need to compare that 2% with the cost of capital. If your cost of capital is 5% and your internal rate of return is 2%, meaning that the project will not be viable because the cost of capital, the cost of borrowing is higher than the return that the investor will get from the investment. However, if for instance, maybe you go for an interview and they give you a case scenario, like what happened to me, I think 3 months ago, thereabouts, right? Giving a case scenario, and that case scenario, they gave all the variables, right? All the inputs that, okay, the sales will increase by this, there's inflation, this, blah, 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 like that. So they now gave internal rate of return to be 2%, I think about 5% thereabout. So when I calculate the NPV, I realize that this NPV is negative. At the same time, I say, since internal rate of return is given to be positive, I can't get, it is not possible for me to calculate this NPV to be negative. It is not. So definitely for them to calculate the internal rate of return, the NPV must be positive. So I have to go back. I check. I adjust. Same thing. So I just have to solve it as like, what could have been the reason? Right. So when you have internal rate of return that is 2% or 5%, and they say you should calculate the NPV, definitely your NPV must be positive. Because how did they arrive at the internal rate of return? Is through the NPV, right? Of course, you do your positive NPV and the negative NPV, right? So if the internal rate of return is higher than the cost of capital, the cost of borrowing, the project should be accepted. But if it is lower, you have to what? Reject the project, because the return is less than the what? Because the return is less than the what? It's less than the cost of what? Cost of borrowing. Please, are we still together?
Yes, sir.
Okay. Now, there's what we call modified duration. I say modified duration, modified internal rate of return, right? Modified internal rate of return. When you are not satisfied with, you're not comfortable with the internal rate of return, you may calculate what we call modified internal rate of return. And you can see the formula for calculating the modified internal rate of return, right? The PVR represents present value of cash inflow, while the PV1 represents present value of cash outflow, or present value of investments, right? Excuse me. Present value of investments, right? So where they have is the cost of capital. The N is the number of years. So this is modified duration, modified internal rate of return, modified what? Internal rate of what? Internal rate of return. And this is the formula, right? If the examiner say calculate modified internal rate of return, the present value of the cash inflow, we'll look at that, the present value of the investment, the cost of capital, and the numbers of years. Now, there's what we call growth annuity. Let's say, for instance, you are to do an investment that is like maybe capital investment project that is for 20 years, for instance, or for 10 years. Because of time, you can't start from year 1, year 2, year 3, year 4. Time go now. Is that not so? Because of time, you can't say if the project is 20 years or 10 years, you can't just start year 1, year 2, year 3, year 4. When will you finish that? So the formula to use to get the present value is the annuity growth rate. The growing what? Annuity. Meaning that if you are given a project that is 10 years, the growth rate given to you will be uniform. They can tell you that the sales, maybe the sales, or yes, the sales is 5%, the sales is 5%, the variable cost is 5%, it's uniform. Now, class, if you want to determine the present value, your sales minus your variable cost will give you your contribution. So the question is, what is the present value of that contribution? So you can use this annuity growth rate, where R is equal to the cost of capital, G is the growth rate. Of course, when you are given the same growth rates, I think we'll look at that under adjusted present value. I think one of the past questions thereabouts, whereby we're given 10 years. All you just need to do is that bring out this formula and check, do your maybe profit, your sales minus your variable cost, you have your contribution minus your fixed cost, you have your profit, you charge your tax, you have your net of tax. If you want to determine the present value from year 1 to 10, you just use this this formula to get the present value instead of doing year 1, 2, 3 to 10. The A represents the cash flow, the R here represent the cost of capital, the G represent the growth rate, and the N represent the what? The numbers of what? The numbers of years. So before I continue with the class, do we have anyone that have question based on what we've discussed so far? Please, if you have question, quickly unmute your mic. Are we good? Are we good?
Yes, sir.
Yes, sir, we are good.
Okay, that's fine. Thank you. Thank you. That's now we need to move quickly to taxation and inflation in capital budget. Yeah, I just want to explain everything before I start solving. I don't want to be doing one. No, just finish the explanation, then go straight to calculation. Tunde,
Hello, sir. Good evening, sir.
yeah, good evening.
Okay, my question goes to when you are explaining under labor. I want to confirm labor is relevant cost, right?
Labor, it depends on the labor.
That's
Is
the
it the
aspect I
full staff?
wanted to.
Is it the full staff labor? If it is full staff, whether the projects continue or not, you will pay them. It is not relevant. It's a sunk
Yes.
cost or it's a committed cost. It's a casual labor. Those people who will just come in and just say, yeah, now we want to work sharp, sharp. You pay them. It's because of the project you employ them. It's not even employee. So you just, let's say you employ them for just to come and do one or two stuff, then go. So it's relevant. So the full-time one, they are not relevant. Whether the project continue or not, you still pay them. You understand?
Okay, sir. Thank you.
You're welcome. Can mute your mic. Okay. Now let's quickly look at the inflation. Inflation under the capital budgeting. Now, inflation. Now, we already know that inflation is persistence-wise in the general goods and services, right? Now, what are the types of inflation under the capital budgeting? We have what we call general inflation, specific inflation. Examiner will not tell you define general inflation, but you just need to know it, Nick. Like, you just need to know it. It's not that it's part of a requirement or anything, right? General inflation and what? And specific inflation, right? Now, The general inflation here is when the examiner give you the a single rate, a single inflation rate class. When you are given a single inflation rate in a question, the existence of single inflation rate, probably the sales variable cost, fixed cost will increase by, everything will increase by 5%. You are given what? A uniform inflation rate on all the variables. That is what we call general inflation. But in a situation whereby they said sales will be 5%, variable costs will be 6%, fixed costs will increase by 10%, right? That is specific what? Inflation, right? That is what? Specific what? Specific inflation. This is a change in the price of various elements that make up the project being investigated. For example, specific inflation affects only the cash flows, while general inflation affects both cash flow and what? And the discount rate. The existence of more than one inflation, that is my point. The existence of more than one inflation rate in a question is known as what? A specific inflation. Sales, selling price, 2%. Variable cost, 9%. Fixed cost, 8%. That is specific inflation. But general inflation just give you one rate for everything. So that means that it is what? It is a general inflation. Right. Now, having explained this, we will now move to where we have the cash flow. There are different types of cash flows. We have what we call the money cash flows and the real cash flow. Class, we need to pay attention to this part because it is very, very important, right? Now, money cash flow, it means that of all nominal cash flow, it means that the cash flow has been what? Inflated. They are inflated cash flows. They are what? Inflated cash flow, meaning that in a question, okay, we'll get to that point, sure, we'll get there. Now, my point here is money cash flow means that inflation has been what? Has been considered because they have been what? Already been what? Inflated. Right? Now, when you see in the question that selling price will increase by 5%, variable cost will increase by 6%. When you calculate it, it is what we call money cash flow. Because you have considered the inflation to be increasing by 5 or by 6%. Maybe selling price will increase by 5%, variable cost will increase by, and you calculated it. The cash flow that you have is what we call money cash flow. Then, real term, real cash flow means that if I pay you salary of 20,000, it is real. It is not nominal. It is real. And someone who is earning 20,000, whether gross or net, will say yes. When you factor in inflation of 21.6%, you end up, you will now know that in money term, your salary is like 15,000 to 14,000 naira. 16. That is why when you have 20,000 naira, you just buy, just try to buy card or just buy airtime, buy anything, just remove 1,000. You will know that yes, that money is just there, right? So that is real cash flow. without the effect of what? Inflation. So in real term, in current what term class. Now we have the money cost of capital and the real cost of capital. If you have inflated your cash flow, money cash flow goes with money cost of capital. You've inflated your selling price, your variable cost, your fixed cost to give you money cash flow. Definitely what you should use to discount that project is to be in money term or the nominal term. So the money cost of capital is calculated is equals to MCCC 1 plus real cost of capital. Definitely, if you want to convert to money cost of capital, you'll be given the real cost of capital. That is why in the formula you have 1 plus RCC, open brackets, 1 plus I, which is the inflation rate, minus 1. Minus what? Minus 1. That is how to convert, how to calculate, or how to convert to money cost of capital. Now, real means in real term. Maybe it is stated in the question that all cash flow are in real term, meaning that it is real cash flow. Then real cash flow goes with real cost of capital. Then if you want to calculate the real cost of capital, if it is not given, of course, sometimes you have to do your conversion, meaning that they will tell you that the cash flow are all they are in real term. Then they will not give you money cost of capital. And you should know that if all cash flow are in real term, definitely what you should use to discount the project should be real cost of capital. Then you now need to convert that money cost of capital given to you to real cost of capital, which is equals to 1 plus MCC divided by 1 plus I, which is the inflation rate, minus what? Minus 1. The inflation rate there is the general inflation, which will be given to you in the question. My point here is money cash flow goes with money cost of capital, then real cash flow goes with real cost of capital. Money means they have considered the inflation, real without the effect of inflation. General rules. Now, use money cost of capital to discount money cash flow and real cost of capital to discount cash flows. Real cash flow are those exposed in year 0 prices, constant price level, current terms, or in real terms. You may see it that all cash flow are in real term or are in current terms. So you should know that this cash flow is a real cash flow. Where the examiner is silent as regards the cash flow or the cost of capital, it is assumed to be in money terms. When the examiner is now silent, we don't even know if the cash flow, they just give you the cost of capital to be 2% or 5%. We don't even know if it is real or if it is nominal. So it is assumed that the cash flow is what? They are all in money term, meaning that you are going to use money cost of capital to discount the what? To discount the project. Right? Although there are two methods you can use, whether money or will. They can give you money cash flow and give you real cost of capital. Then I normally advise that just convert that money cost of capital to real. You can actually convert the money cash flow to real. You can convert it, but that will take your time. So just convert the real to money or the money to what? To real. So the last one here is any item stated in year one prices attract no inflation in year one unless stated otherwise in the question. That is, inflation becomes applicable from year two. We'll see a lot of questions like this. Then the person will now say, Mr. A will say, no, raise it to power one, two, this one, three, this one, four. The thing is that it depends on what is given to you in the question. The question may tell you that the inflation will start from year two. Meaning that if your inflation starts from year two, that your year two is year one. Right? Sometimes inflation will start from year one or per annum, like that. We'll get there actually. Right. So taxation, of course, because of taxation is not actually, depreciation is not actually allowed because of, for tax purposes, and that is why we have capital allowance. It's granted layer of depreciation. Now, sometimes the qualifying capital expenditure, you can claim capital allowance on it, on the cash, on the assets itself that are used for the project. Now, balancing allowance or balancing charge. Balancing allowance is when the sales proceed is less than the tax written down value, the value of the what? The assets. So therefore, you have balancing allowance. When you have balancing allowance, you will still claim capital allowance on it because it is a loss already, where the sales proceed is less than the capital, is less than the what? The tax written down value. Now, in a situation whereby you have balancing charge, is a gain on disposal. When you have a gain, whereby the sales proceed is higher than the tax written down value, when you have gain, you don't need to charge capital allowance. You have gain. That gain will be subject to what? To tax. Attract what? Tax. Is that not so? So under the capital gains tax, we can say, okay, we just take it there because you're not being in profits, income statement. Take it to capital gains, right? Under that is under capital gains, under tax too, right? So when you have the balancing charge, of course, it will attract what? Tax. So lastly, sensitivity analysis. Now, sensitivity analysis, the question is, what is sensitivity analysis? Sensitivity analysis is a changes in a variables like selling price, like fixed cost, like the tax rate, cost of capital, and so on. Meaning that if there is as a project finance officer, if there is any change in this variable, what is the implication? Because the question will tell you that calculate and interpret. It's just like you want to calculate and interpret margin of safety. Even in modeling, you still need to calculate margin. In final, even in project file, you still need to do sensitivity analysis on that project. What does that mean? It means that you calculate sensitivity analysis. Sensitivity analysis of variable cost is equals to NPV divided by the present value of the variable cost times 100. Then you calculate the sensitivity analysis of variable cost to be 20%. What is the interpretation? The interpretation is that you should not allow this variable cost to increase more than 20%. If not, the NPV will become what? Zero or negative. Meaning that as a project finance officer, the variable cost, the labor and everything costs 50,000. And they now come to you that, okay, we need to add this person. You can now show them, this is it, my analysis. If we add one labor to this project will become zero or negative. With that, we are not maximizing shareholders' wealth. So when you are calculating sensitivity analysis on anything that has to do with costs, it must not be above that percentage. Anything that has to do with costs, whether fixed cost, whether variable cost, or the cost of capital as well. You should not, you calculate it maybe 20% or 30%. You should not allow it to do what? To increase more than, that is, you should not allow it to increase more than that 30%. Because if it increases more than that 30%, what is the implication? The implication is that the NPV may either become zero or negative. Right? So that is why when you are forecasting for the future under the project, either under modeling or any, you have to provide a margin of safety. You have a client as an investment analyst, you have to, because you are looking at a point at which this thing will be safe. It will be safe like this for us to enter the market. And if we go beyond this, this is what could happen. Right? So when you see some people performing a sensitivity analysis on a project, is no magic. They started the project from the NPV. They started from the NPV. They gave you the index or the input or the variables that to be used. Or if you want to do fresh modeling from scratch, you started checking for market, doing market research. How much is this in the market per one? How much is this? How much is this? How much is this? How much is, just like you want to prepare financial statement from scratch for a company that does not even keep records. So you have to fall back to the bank statement, start from this scratch, right? So that is my point here, under the cost. But under contribution, when you have the sensitivity analysis under contribution or selling price, right? Under what? Selling price. Maybe you calculate sensitivity analysis to be 40%. It means that you should not allow that 40% to fall, to reduce more than that 40%. So if not, the NPV will become zero. You know, when you are talking about the cost, you should not allow it to increase. But when you are talking about inflow, you should not allow that percentage to fall below 50%. If not, the project will be what? Will be negative or zero. That is the analysis between the cost and the what? Between the cash outflow and the what? And the inflow. Class, Kajiko, I don't speak.
Kajiko. Kaji Koyin.
Munji.
The- okay. So please, do you have anyone that have question? Interesting. So capital rationing no be today. Capital rationing is another part. I will take capital rationing, decision tree, simulation all together. So I'm taking MPV, internal rate of return, the inflation, all those parts. I will take it all together. So the capital rationing, decision tree, and simulation, another parts, right? So can we look at the question? Thing is that I'm still working on the material actually, but I'll update the folder on or before weekend. Hopefully, I should do that. So I have a question here. So you can screenshot the question. You can screenshot. Um, you can screenshot the question. Should we solve this question? So, okay. I think this question tests this thing now. Relevant question, right? Okay. Let's use this question to start. Question is adopted from ACCA. 20 marks. Okay. So are we good? Class, are we good?
Yes.
Okay. That's fine. Okay, that's fine. So let's quickly look at this question together. Right. Coming. So what is the required? Who will read?
Required. A. Briefly explain the concept of relevant cash flow when making the decision of whether to undertake the project or not.
Okay. B.
B. Calculate the net present value of the project and recommend whether the MTD should be produced. Provide a brief justification of the cash flows included and excluded in the calculation.
Okay, thank you. So I don't need to explain anything from this A, 3 marks, right? Briefly explain the concept of relevant cash flow. A cash flow that are relevant for the project, right? Then you can talk about some costs, committed costs. It's 3 marks, You talk about all those things. So that is the explanation there, 3 marks. So calculate the MPV of the project and recommend whether the MTD should be produced. So meaning that this is a capital investment project.
Hello, sir.
Yeah.
Sorry, the question A. They said briefly explain the concept of relevant cash flow. You are talking about sunk cost, but sunk cost is not relevant.
Okay, thank you. Thanks for the correction. So talk about the cash flow that are relevant. Do you get?
No, sir, not really.
You don't get. What are the cash? I see. I just explained something. Explain the relevant cash flow. Relevant cash flow are cash flow that are relevant for a particular project. Then you can mention opportunity cost. You can mention incremental fixed cost. You can mention variable costs. Is that not so? These are relevant costs or relevant cash flows
Yes,
that arise on a project. So that's it. That's what they say you should do.
Okay,
Do you
sir.
understand?
Yes.
Thank you. Yeah, thank you. The next one is the MPV, right? So okay, please go ahead. You can read.
Okay. Penny Limited is considering a project whether or not to commercialize an innovative muscle toning device, MTD, that will be used in the treatment of sporting injuries. It is expected that the commercial life of MTD will be 4 years, after which technological advances will bring more sophisticated devices to the market and the sales of MTD will fall to virtually zero. 8 million has been spent in developing and testing the device over the past year.
Okay, hold on. Sorry. Thank you. Now, over the past year, right? This 8 million that have been spent, is it a relevant cost?
No.
No,
No.
it is some
No.
cost.
The song.
Thank you. So that is what you will state in your B, because we have to add notes to it, right? We can state it that okay, developing and testing device has been spent before the project, therefore it is not relevant, right? Okay, please go ahead.
Okay. Initial market research has been conducted at a cost of 2.5 million and is due to be paid shortly. The
Okay,
market research indicates the following demand and selling price per unit.
okay, thank you. This market research of 2.5, is it a relevant cost? Class.
No.
Irrelevant.
Okay, it's not
Is it relevant for?
okay, that's fine. That is well noted. Right. Okay. Now, okay, thank you. Thank you so much for that. Now, a factory will be built for the production of MTD. You can see the demand. We can all see the demand. Now, it started from year 2 to year 5. A factory will be built for the production of MTD for 30 million and will take a year to complete. Payments will be made in 2 installments. The first installment of 18 million is payable immediately, and the remainder in a year's time. Meaning that if they want to build the factory that they will use for this innovation, it will cost them 30 million. That 30 million, they will pay it immediately, right? Of course, when they want to do it, they don't have anything. It is at year 0, right? Why the balance will be paid and the remainder in years time, right? That is year 1. Don't forget, I have 50,000 naira, or I want to go into a project now, and for me to build that plant, I have to spend 50,000. That 50,000 naira, you've not even commenced the project. It will be at year 0, right? Now, the factory building is expected to be sold for 25 million when the production and sales cease. At the end of the period, there will be a sales proceed on the factory building that they built, right? Now, then we have machinery. After they've built, they have the factory building. Now they have machine that they will use to produce, and the machine costing 16 million will be installed at the end of the first year. Will be installed. That is when it will be installed, but the cost will be at year 0, where you've just buy an equipment that you want to use for a project, will you say it started at year 1? No, it will have to start at year 0, because that year 0, that it is assumed that you've not commenced operation. Now, the machinery will be depreciated on straight line basis over the next 4 years, and it's expected to have a new value at the end of 4 years. So the scrap value will be nil at the end of 4 years. Depreciation, we can, in our notes, we can add it in our notes that depreciation is not a relevant cost. At present, the material cost of making one MTD unit is 700 naira per unit. That is the material cost. Of course, material cost is relevant. Material, because that is what they will use in the production. Kenny Limited has enough material in inventory to make 1,500 MTD units, meaning that Kenny has this material of 1,500. And the market research is showing that the demand will be 2,000. Class, the market research is showing that the demand is 2,000, but what they have in the store is 1,500 units. They need to source for the remaining 500 units. Now, which had purchased a year ago for 450 naira per MTD. This one that they have here in the store, they purchased it a year ago at 450 naira per unit. So the 450 here is a sunk cost a year ago. Now, if the project does not go ahead, then these materials will be sold for an equivalent of 120 naira per unit. Meaning that if we didn't want to go ahead for this project, of course, we've already said we want to build, they've already built a factory already. Definitely, the project will go ahead. So you can see that they have forgone the part of if the project does not go ahead, then this material will be sold. Of course, they want to execute these projects. Right? Now, what they will forgone of 120 plus what they will forgone of 120 naira per MTD, they have to consider it as part of the costs. They have to, because they would have sold it at 120 and the project will not go ahead, right? Right. We'll get to that point again, right? I'm just explaining how we'll treat it. Now, labor that will be used to make the MTD is to be made redundant immediately at cost of 2 million. Right? If they want to produce the MTD, they have to pay some labor. They have to pay a redundancy fee of 2 million. The redundancy fee is relevant because it is for the project. That's the reason why they say, okay, let these people should go so that we can bring in casual laborers that they can just come and work. Of course, these 2 million will not throw it out. Will not just throw it like that. If the project does not go ahead, labor cost per MTD unit are 250. If the project does not go ahead, okay. They finished that part. Labor cost per MTD unit are 250. Of course, they will need labor. Class. Immediately as they want to engage, they want to start this project, before they even start, redundancy fee of 2 million out. Labor, of course, they will pay labor 250 per unit. It is expected that once the project is completed, the labor will be made what redundant at a cost of. So that is to say, those casual labor that will still come and work for this project, once we are done, when we are done with that project, everybody should go. But we still need to pay them 3.5 million, which is still relevant for the what? For the project. Fixed production overhead relating specifically to the production of MTD are expected to be 6,500 per unit in the first year of production. In the what? In the first year of production. That is year 2. And variable production overhead are expected to be 150 naira per MTD unit produced and sold. Variable production and fixed production specifically to the production. So it's allowed, it's relevant. Administrative costs are expected to be 17 million per annum, of which 5,500,000 is allocated from the head office class. Anything that has to do with allocation is not a relevant cost, meaning that we have to remove this 17 from we have to remove 5.5 from this 17, and the remainder relates directly to the food. So the balance will not be a what? Will not be a relevant cost. Working capital of 10 million will be required at the beginning of the second year, which is year 2. And that is what was stated here, 2, 3, 4, 5. Once the production and sales of MTD have commenced, this will be released when the production and sales of MTD ceased at the end of the year, the end of the 4th year. The relevant cost of capital for the project that we will use to discount it is 9%. Assume that all cash flow occur at the end of year, unless stated otherwise. Now, you can see in this question now, you can assume that all the cash flow are in money term, because that is the principle. All the cash flow are in money term, and the cost of capital is also in money term. That is what we assumed. That is the general rule, because it wasn't stated, everything was silent. Right? So we need to start our computation of MPV. Suggested solution. What is the name of the company? Kenny Limited. Kenny Limited. Where are we going to start? Where should we? Okay, let's start from the sales. Okay, year 0. Year 1, of course, they didn't give us year 1, right? They just leave it like this because of year 4. Okay, we can do our workings here. We have sales. Let's start from the sales, the selling price. So we can multiply this selling price. So you just give me figure so that we have our sales. So we can have sales. What is the sales? If you multiply it, what do you have? Sales.
4 million.
Okay. Okay, 4 million. So this will be 4,000. Next.
That's 54,000.
Year 2. Year 3.
154,000.
Okay, 154. 154. Year 4.
200,000. 200.
Five,
Okay,
28,000.
thank you. 28,000. Thank you. Right? Thank you. So if this is our sales, we can now bring it down. Please mute your mic. We can now say sales, right? Sales. We need to think I need to do something like this. Sales. 4,000. This is 154. To which year self? Okay, 5. Started from year 2.
The question.
Yeah,
I noticed this year put 4,000, but the other ones it's not supposed to be 154,000.
you already have this thing now. You already have.
Yeah, it's supposed to be more than this
It's
4,000.
in
If
million.
It's in millions. So.
I mean, year 2 should be 4.
1,000, yeah. Is it like this?
154 million.
Yes, sir.
Yes, that's it.
Okay, that's fine. Thank you. So we can have 200. Then this is 28. Right. So we move to the variable cost. Let's quickly move to the part of the cost. Right. Let's forget the year 0 part of all this. Let's move to the material. Right. Now, please, you have to create a page where you will this part, the development and testing, probably at the end of the class. Maybe at the end of this, you can just say notes. You can just choose notes and notes 1. Development. You see it now, development and development testing and market research. Not irrelevant cash outflow or cash flow. So you do the same thing with others as well, right? In case we don't have that time to write all these things. So we move to the part of the sales, right? So now let's quickly move to this part of material. Let's just forget about this cost. We'll come back to costs. Or should we treat cost now? Okay. Let me bring this. Now, don't forget that the factory building will cost what? the factory building will cost 30 million, and the first installment of 18 million is payable immediately. That is at year 0, when we've not even started producing at all. We'll be at what? At year 0. And the remainder in a year's time. After year 0, you have year 1. So we can have factory building. Factory building, right? 18 million will be paid. Is 18 million, right? 18,000. Okay. So the balance 30 million minus 18. What do we have? What is the balance, class?
12.
million.
So 12 million.
12, right? Okay, 12. So the remainder will be paid a year after. Let me see. Okay. So just a minute. I don't know why. Okay. 12. Okay. So we can move to the next one. What else do we have? What else do we have? So the factory is expected to be sold at the end of the year, which is to be sold at the end of the year, at the end of the production and sales. Is that also 250 million, right? So we have 250 million. In this
25
question,
million.
25 million. Thank you. Sales proceed. Sales proceed. So 25 million, right? 25 million. $25 million. So what else do we have? We have to bring in the costs. So what are the costs? We still have the machinery costs. Costing 16 million will be installed at the end of the first year. Class, that is the installation is at the end of the first year. The machine, before they start production, they need machine. That is at year 0. So we can still have machine. You can see that in this question, capital allowance, the question did not say anything about capital allowance. Just ignore it, right? When we see in our next, I think the next question, we have capital allowance there, right? So we'll check that question as well. So what we have here is machine. The machine cost. What is the machine cost?
16
What is the machine?
million.
15.
16.
Okay, 16. Okay. Okay. So we can move further to check for all the relevant costs now. Now, this material class, are we still together?
So I think
Yes,
this is
sir.
not end of year 1, the 16 million.
No, 16 million is not at the end of the year. They say it will be installed. will be installed. It is when they will install it will be at the end of the first year. Is that not so? At the end of the first year. Okay, that's true. At the end of the first year, sorry. Thank you. So at present, the material costs of making MTD units is 700 naira per unit. 700 naira per unit. Penny Limited has enough material in inventory to make up to 1,500 MTD units, which it's had purchased. This is sunk costs. We don't need this. Now, if the project does not go ahead, then this material will be sold for an equivalent of 120 naira per MTD. Class, the first thing we need to establish here is that first, this is a sunk cost. The 450 is a sunk cost. Now, what is the demand? The demand is 2,000 units. And we have 1,500. This 1,500 will cost 700 naira per unit. Or this 1,500 will cost how much? And let's do it this way. We have 1,000, we have 2,000. No, the demand is 2,000 units. And we already have 1,500. Meaning that if you want to buy the material today in the market, at present, will be 700 naira per unit. So the remaining 500 will be the current cost. We'll go to the market and buy the material, which is the 700 naira per unit times the 500 units. One cost. Now, the 1,500 units, because we have it in the store, we have it. But if the project does not go ahead, we can sell it. Opportunity cost. We can sell it and make money. Now, the law now says that, that's what is the cost of that material if we are to sell it out. If we are to sell it out, it will be 120 times 1,500 units. That will be the cost. We need to add it as part of the cost. We need to do what? We need to add it as part of the what? The cost, the material cost. Then we need to go out and source for the 500 units, which costs 700 naira per unit. Class, are we still together? Who is against me in this class?
So sorry, that means the 120 is the scrap value.
The 120, yes, we can say it is the scrap value. You can call it scrap value. Material cost. Current costs. Presentation though. Material costs. Okay, let's see. Okay, let me do it this way. Current costs 500 units times 700 naira per unit. Don't forget that the demand is 2,000. Demand is equals to 2,000 units. And the current cost, because 2,000 units available is 1,500 units. We need to purchase 500 units. Are we there? Are we still together?
Yes, sir.
Yes, sir.
Opportunity costs. We have the 1,500 units times how much are they going to sell it if they go ahead with the project? 120. So what is the total cost of the material? What is this? If you multiply this, what do you have quickly?
350,000.
The first one is 350,000. What of this? What do you have?
180.
180. So what is the total material cost?
530.
What is it?
530.
530,000. Please, who is against me in this class? Material costs.
Sir, please, why are we adding the opportunity cost?
It still costs. Why we have to add it is because we want to go ahead and we want to go ahead. They want to like go ahead and they want to go ahead for the project, right? This is opportunity cost, right? They said if the project does not go ahead, then they will sell it out. They've forgone this. They've forgone this 120. They've forgone it. This amount, the value at which they forgone, we have to add it to the cost. Because we would have make 120 times 1,500 from the what? From the sales. But because the project, they've already built the production, then the project, they want to go into the project. Do you understand?
Okay, yes, thank you.
What they forgone, we have to add it to the costs. Thank you. Material cost, or you can separate it, the current cost, 350, opportunity cost, what they forgone, right? So at year two, sorry, you will have 530. Now, what will be the costs after year two? What will be the cost after year two, class? The 700 naira per unit times
70,000 units produced.
Thank you. After that, 700 times 125. 700 times 20. Right? So, material. Okay. So this is material costs. Material cost is 700 naira. So minus here 2, right? Let's see, this is 700. This is 700. This is 700. Class, what is this is material cost per unit. So what is the material cost?
49,000 for the first one.
49,000. Okay, just a minute. 49,000. 49,000. Next.
The second one is 87,500.
500.
87,500.
500.
Next.
14,000.
14,000.
14,000. Okay. So year 3, 49,000. 49,000 year 3. Year 4, 87,500. Then 14,000. Okay. So which other thing do we have? Let me check. After material,
We
we are
have
done
labor.
with so all these things that you have to state it in your notes. Do you get? You have to state it in your notes because the examiners still want to see your note as well, right? You have to just state it in your notes. Okay. Labor. So labor that will be used to make the MTD is to be made redundant immediately at costs of 2 million if the project does not go ahead, meaning that they have to pay a redundancy fee of 2 million, right? They have to pay, I'm coming, yeah. Labor that will be used to make the MTD is to be made redundant immediately at a cost of 2 million if the project does not go ahead. Meaning that if they don't want to go, if they don't want to embark on this project, they have to pay 2 million. And with the look of things, if you look at what we've been reading, they've already built the factory already. They want to go into the project, right? They want to embark on the project, right? So this 2 million now, since the 2 million will be like a savings to them, right? Now, labor costs per MTD unit are 250. It is expected that once the project is completed, the labor will be made redundant at a cost of 3. So if you finish the project, there will be a cost of 3.5 million, right? Now, how do we now treat the first 2 million that says if the project does not go ahead of 2 million? Class, how do we treat the 2 million? Are we still together?
That we will treat the opportunity cost because it's a condition of if the project does not go ahead.
Okay, there's a condition there. That makes sense. So are we going to treat it as an inflow or outflow? Kende?
All right. Good evening, sir.
Good evening.
To me, I think this looks like an affordable cost for us because of the clause, if the project does not go ahead, it means that this cost is affordable. And so it's not relevant because if the project is not undertaken, right? If the project does not go ahead, then it means that they have to pay them 2 million naira. But if the project goes ahead, we can afford that. But we are not going to be able to afford the labor cost of 250 naira per hour. per unit of the MTD produced. So that's just my view.
Okay, that's fine. Ola?
Okay, I believe I believe there is an idle labor there, so therefore the cost is irrelevant.
Interesting. Okay. Because of what I have here, I'm thinking if I can complete this. Hold on, please. Just hold on. Michael. Michael. Good evening.
Good evening, sir.
Good evening.
I think, like one of the speakers said, the 2 million is an avoidable cost. And if we are going to undertake this project, this 2 million is going to be a savings for us.
A savings. Yeah, a savings. That is the word there. Savings. Thank you. That makes sense. Now, meaning that if the projects it is an avoidable cost that we have to save the 2 million at what? At year 0 immediately. If the project does not go. Of course, you have to consider the cost as well, because we are still talking about the projects. So the 2 million will be like a savings to us. Labor costs or redundancy. So 2 million. Then at the end of the project, they have to pay this 3.5. They have to pay the 3.5. Then the 250 is per unit. So we'll have 250 times 2,000, 250 times 70,000, 250 times 125, and 250 times 20. Class, are we still together? Who is against me in this class? Are we still together, please?
Yes, we are.
Okay. That's fine.
Sir, I have a bit of reservation there. I don't know. Hello, can I go ahead, please?
Please go ahead.
Okay. From the word redundant, so that means there is some sort of if we are not embarking on this project, it seems that the already existing labor will not be needed.
Yes, and we have to pay them.
That means we have a space capacity from what we already budgeted for.
No, redundancy means that we don't need them for the project.
If we are not embarking on the project, okay. It's not as if they already exist. Okay, that makes sense. Okay, that makes sense.
So we don't need them.
All right, that makes sense. Thank you.
Okay, thank you. Labor, right? So what is the cost per unit, class? What is the cost per unit?
250 naira.
250. Okay. So what do we have here?
We have 500.
500.
17,500.
17,500.
31,250.
31,250. So we'll continue from here. What do you have?
5,000.
5,000. So we'll continue from here, please, in our next class. Right. So apologies for yes, please let's continue from here in our next class. So do we have anyone that have questions for me, please, before we go? Okay, Mary. Mary, pick one.
I wanted to ask from the previous class, the example you said you are going to solve about convertible shares under bond valuation. Are we still going to do it?
Okay, we'll do that maybe during our intensive class. I reserve all those questions. Yeah, so that's intensive.
Thank you.
Yeah, thank you. Thank you. Is any other question? Please, this material will be ready maybe on or before our next class. On or before the next class. So we'll look at it. Then we have a lot to do here under investment appraisal. Investment appraisal will take us like 2 weeks. Yes, 2 weeks. Then our next class will start at 11 a.m. on Saturday. Please make yourself available. So on this note, I think we have to go. Thank you so much, everyone, for joining, and enjoy the rest of your evening. Thank you. Ola?
Okay, thank you, sir. Thanks for the class and the effort. We really appreciate it. So I have a concern, sir. So when you try to explain the relevant cost when it comes to labor, you understand? So there is this particular statement in the notes you make mention of. So it's just in the material, just that I did not note it at that time, so I can't really point out to it, but I can speak to it. So where you on the material, it says that I can't really get it.
Okay, I'm coming. Just hold on. Just hold on.
Okay.
This is it.
Okay. There is a particular example which says that if the oh my God, you highlighted that point.
Okay. I don't forget to.
Yeah, you are it. So no.
Okay, maybe later, maybe in our next class.
No problem. If I see it in the material,